My next guest called for a significant market rally back on March 21st near the lows, predicting the S&P would hit 2950 by the end of April, and we just about got there. But now he says this recovery rally has likely run its course. For more, let's welcome in Barry Bannister. He's head of institutional equity strategy for Stifel Financial. Barry, tell me why.
Well, thanks, Kelly. We got off the risk rally on after the close the April 29th, and we've seen a 5% pullback for stocks since then. I do think investors are worried more about an L-shaped non-recovery outcome in the second half. You know, it's a self-imposed depression, and it's pretty frightening for consumers, business, and it's affecting market sentiment in general.
Right. And the interesting thing here, though, is that you connect this directly with the Fed. Tell me about your strategy in general as it relates to the Fed and what you think happens this time around.
Well, the Fed has tended to act only after an event. So if there's a shock, it's the Fed steps in. So it's best to step out until the Fed steps in. And when we saw the Fed somewhat satisfied with what they'd already done, we felt like a lot of the bad news had been mitigated. The price had risen. Intraday, we did hit 29.50 on April 29th. So I pulled the plug on April 29th after the close.
So now, if you're in a scenario where you say we're going to kind of require another shock in order for the Fed to do something, well, why can't we just have neither? Can't we just sit here and say, well, we don't need the shock and we don't need the Fed to do more? Why do you think both of those, that sequence of events is likely to play out?
Well, it's not entirely the Fed. I mean, we've got consumers are just terrified. Business is skittish that they won't be able to turn a profit with social distancing. We've got some state governments drinking the Kool-Aid, so to speak, and delaying the reopening. So I think a perspective is important. What we have right now is a fear multiplier. If you think about it, COVID lifted the normal annual death rate in the U.S. by about 2.5%. But that's been magnified many times over by fear. And so my concern, and I think it's starting to be reflected in the market, is that a prolonged or recurrent shutdown is going to be the economic policy equivalent of Jonestown for GDP. And we just can't afford that if you're investing this long at 2,800 plus for the S&P.
So what you're saying is if the virus causes more shutdowns in the future, there's no way we have 2818 on the S&P where we are today. My question to you is, what if there are no more shutdowns because there's no appetite for it amongst much of the public?
Yeah, I don't think there is an appetite for it, and I sure don't think politicians would take the risk as well. I think we have to adapt to it. But that would mean that we will probably see the efforts to reflate the economy through fiscal and monetary policy really get some traction. And when that happens, what will happen is PE multiples would contract even if earnings recover. And so the stock market would just tread water for quite a while.
And is that, Barry, last question, your call? So you raised your price target, obviously, at the lows to 29.50. We hit that level, you said, then you kind of moved to the sidelines. What's the call now, that we stay or that we don't run back above 29.50 for the remainder of the year?
Yeah, I think the little rally we've had since April 29th, where the defensive stocks, and I'm thinking utilities, healthcare, consumer staples, they had a little bounce after having sold off. During the big upturn in the market, it was risk on, and so the cyclicals, everything from technology to energy to financials, industrials, they did very well. I think that as we get economic traction, if we don't have any more shutdowns or talk of that, if we get reopening going in the second half, I would favor the cyclical stocks as we close out the year. And that's what I'll be emphasizing mostly. Since I don't see a lot of S&P upside, what I'm focused on is sector and industry and then eventually stock selection.
Sure. So there you heard it from Barry Bannister. If you think we get some traction here, the cyclicals are the place to go.